All right, here we go. Last week of August. I guess theoretically, last full week of summer, sort of. I guess I don't know. I feel like Labor Day. I guess it's not right. Next week is really the last full week of summer. Anyway, overnight stocks mostly down, indicating down here on shore. VIX up 5%, Bitcoin up to 78 and change. Continues that sort of hedge against stocks lately. Um, Dollar mostly stronger versus world currencies. Brent crude better on the day, down about 2% each, still in the 80 and 90 handle. Gold, platinum, copper up. Not a lot of overnight data. What we did get was mixed and nothing here on shore. We've got 2 o'clock. Sounds like Besant is going to speak. Perhaps he's going to elaborate a bit more on the economic D-Day that is coming at Iran like a freight train. And, I don't know, maybe that's why we feel slightly better about oil today. Sort of getting a headache trying to keep up with that. Uh, Really, not a heck of a lot to talk about today. Nothing really happened over the weekend. One of the things that we did talk about, excuse me, was if you wanted to take some risk into the weekend, because really we didn't have anything hard hitting until perhaps 8:30. Although tomorrow's data is reasonable. Didn't really have anything hard hitting until 8:30 tomorrow. So you got a couple free looks, so to speak, and that's and you were basically betting on some better news out of Iran. I don't know that we got that, but I guess it wasn't bad news, and I don't know, maybe we feel good about this economic D-Day. Anyway, 2 to 5 ticks better on MBS. Treasuries are 2 to 3 basis points, even 4 basis points better on the day. Tens knocking on a 4-6 handle doorstep. We started 843 on the 21st. We were at 469, so we got worse throughout the day Friday, and here we are kind of back at those levels. Um, Purely on a chart basis, we're almost float across the board. A 2-day chart where gosh, a good 3-4 ticks worse, depending on where we struck. So at 10:42 on Friday morning, or 10:44 for lenders that might have struck at 10:44, we're actually a couple ticks better. So there's a chance that you're going to actually see rates slightly better on your rate sheets. I'd almost guarantee 6 3/4 and above will be better. Other than those who struck super duper early. But if you struck in the 10 o'clock hour, you're going to probably be maybe even an eighth better in price. Kind of across the board. These are, this is sort of one of those weird, and maybe weird's not the right word, but weird mornings where rates are worse than when we spoke, but rate sheets are going to be better. Because of just timing and some volatility. With tomorrow, I believe tomorrow's refi day, right? With tomorrow being refi day, I'd imagine your refis are locked up for the month. Maybe your purchases aren't. So how do you handle that? Well, it's a great question. Tomorrow we've got ADP at 8:15, some Fed speak, some housing data that's not going to super move the market. Wednesday NBA apps, and then an early GDP with obviously it's going to be first revision. We're going to really more concentrate on PCE. Expecting those numbers to be flat-ish month over month, possibly down depending on what you're looking at, possibly up. You're getting, in theory, like 6, 7, 8 different PCE numbers on Wednesday. So depending on what you're looking at, market is sort of expecting better or worse. Jackson Hole starts Wednesday, claims on Thursday. and some data with the conclusion of Jackson Hole on Friday, and a speech from Warsh mid morning Friday. Um, so yeah, it's an interesting week because I mean, I guess Jackson Hole is a headline. Hey, Bob, a headline event, but you don't have really too many headliners. GDP would be for me if it wasn't the first revision. We already have a sense of what we're going to get. That being said, there have been some pretty wild swings on revisions in GDP, so maybe it is a headliner. Um, to me, what we're looking at is non-farm, right? And one gets the sense, pending some of this employment data tomorrow, Thursday, uh, one gets the sense that we're kind of lined up for another bad number. And that would be two or three, with the revisions, arguably three or even maybe four okay to bad numbers. I think when we look at Jackson Hole this week, one of the things that you're going to want to really weigh, and certainly I'm going to weigh, is this push and pull between inflation and employment. Um, One of two things is going to happen unless we get some sort of shocking employment number. We're going to have the employment situation continue to worsen, and then you may have a jolt, no pun intended, of inflation. And what's going to win, right? When the Fed weighs inflation against employment in their dual mandate, which is going to prevail? I think this is a really interesting data cycle that we've got coming up because, in theory, there are three things that we're looking at, right? We're going to look at the economy. We're going to look at the employment situation. We're going to look at inflation. You would think that these three things, don't move independent of each other, and B, there's some tremendous correlation, whether it be same direction or the opposite direction. So, if we get a bad jobs number, we may or may not get a bad GDP number. We may or may not get a bad retail sales number. Last one was bad. I know we've tried to excuse that away. If we get a hot inflation number, does that mean the economy is good? As we've discussed, no, doesn't mean that. Used to mean that in a lot of ways, doesn't mean that. So, I think the most likely outcome here is that we're going to get some bad economic data. We're going to get some bad employment data, but we may have a little bit of a bump in inflation because of energy prices. What's going to prevail there? That's a harder call, notwithstanding any noise out of Iran, right? Because even if we get a bad inflation number, but the conflict ends, I think we don't care about the inflation number at that point. That is a variable too. That's like potentially a fourth scenario, where you get a bad inflation number, but the conflict ends. That's a scenario whereby we probably continue to be range bound. Bad inflation number, but also bad economic data, and the Fed has reason for pause. Another possible outcome that would line up to this September sort of time frame for where I said I thought that rates would be lower. That thought is gaining momentum in the market, and some folks are going crazy, and I understand why. The last two Septembers have been incredibly rate friendly, not somewhat rate friendly. And I think folks are calling for that a little bit. They're calling for some bad economic data here. So long story short is, just like the July numbers, the August numbers aren't really affected by some of these higher input prices into energy. It has been choppy. Now, for sure, average price per barrel has been higher in August than it was in July, but it hasn't been nosebleed the entire month. So I think that there's a real chance that, call it 30%, 35%, that all three things go the way of bonds. You don't have a terrible inflation reading, and you have bad employment and economic readings. So I want to be careful with what I say here, but I am about 70-75% resolute in the fact that this next week and a half, 2 weeks of data, push it out 3 weeks because you're probably getting CPI around the 10th, is going to be very bond friendly. I'm at a point where I would be surprised if it wasn't. And to the extent that the inflation data isn't, there's a chance that perhaps in the components, and we talked a little bit about this, right? For last month's inflation data is, all right, we know there were some higher oil prices, but did it make its way, and it might have made its way to the pump, but did it make its way into the cost of goods? And it largely didn't. And so that might happen again. So, that's sort of where we are. I am definitely more float biased than I am lock biased right now, but that's not without risk. And we've got. I saw some article, by the way. What was interesting is, folks are trying to figure out what next steps are, where we stand, so on and so forth. And one of these articles was basically about President Trump playing sort of checkers versus, rather chess versus checkers, in that, and they brought up this chart, by the way, real shock, what I'm about to say is, the last whatever, 2 or 3 or 100 recessions brought with it lower interest rates. So is the president trying to force us into a recession by stringing out this conflict in Iran, among other things, renewed tariff nonsense with Canada? Has he tried everything? And let me Google that for a second. I wonder, and I'll share the article if I find. But basically, he's trying to force us into a recession to create lower rates. Aside from whether or not he's actually trying to do that, right? In other news, the sky is blue and the sun rises in the east. Yes, we know that recessions generally lower interest rates. I am not seeing. Trump aid. Oh no, that was in 25. This is, again, this was even a year ago. So yeah, I can't find the article I read, but long story short, the only way to get rates lower, right, is to have nowadays is to have the Fed intervene. That's not really how it works, and the Fed intervenes when the economic data is bad. So, he's trying to get rates lower, and the only way to do it is to kind of force the market's hand. Interesting thought. I don't know that it's the president's job to try to force an economy into recession. Again, just like the Fed's meddling, I would hope that that's not coming out of the White House, but we'll see. Should be an interesting data cycle coming up. So, long story short, I think if you see rate sheets better today, the question you need to ask yourself is, am I willing to take this risk into Wednesday morning and then bet on a negative revision in GDP, and some tame PCE numbers? I don't think that's a terrible bet. I think it's an educated guess, but you're taking risk. And the thing about risk is bulls and bears make money, pigs get slaughtered. I will see you guys tomorrow. Have a great day.